time to call the August Finance Committee to order. Do we comply with the open meetings law?
Yes, we did.
Okay. Got the meeting agenda. Anything you guys want to change, move up, move down? If not, next item of business is the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. Linda, do you have any comments on something that's not on the agenda?
Mr. Paulson, if I just might make my comments during public comment, and then you can address them or not when you get to those items, and I won't be interrupting the meeting. First is with regard to the sales tax reporting, that the exhibit that you get that gets updated monthly, and it shows sales tax collections ahead of previous years. I would be very happy to do an online demonstration of some of the reporting, the graphing that's available online at the Department of Revenue. It's really easy to see that for a long time now, it's retail sales that drives the sales tax receipts for Sawyer County. And then also, it's very interesting to compare our county versus our neighboring counties. So when you consider things for the budget, like possibly continuing to fund the Visitors and Convention Bureau, you can also see the sales tax collections by accommodations and food service. So if the county staff doesn't have time, I would love to just do a demonstration on the computer, and you can look at it or record it for future reporting. Also, when it comes down to the ambulance report, last month I made a suggestion that the supervisors be able to look at a breakdown of collections as far as the time past due. Another thing I would like to request is that the supervisors on this committee take a look at and see how much Sawyer County is charging towns in Washburn County to provide service, as well as what is being allocated to the towns in Sawyer County. There was a big discussion at the town of Edgewater last night that basically they're paying upwards of $55,000 a year and just getting mutual aid service, while neighboring towns in Washburn County are just being charged a few $1,000s. So that would be another thing to look at for budget, because I know that the town board did not come forward to the committee of jurisdiction last year, but they do not feel that it's fair to be assessed for ambulance service when we are contracting, or the town is contracting with Birchwood for that. Thank you.
Okay, thank you. Anybody else online, do you think, that has public comments? Okay, next item of business then be the meetings from the minutes from the July meeting. I guess I'd entertain a motion to approve those.
I move to approve.
Okay, is there a second? Motion's been made and seconded. All in favor, aye?
Aye.
Opposed? Motion carried. Okay, next item is the preliminary 2021 budget.
Okay, so we've gone through the budget process with the departments. Departments turn their stuff in, and we have compiled what we've received from the departments. Cindy, can you, I think you're one report ahead on that online.
This is what shows as page 1.
7A is the one. There you go.
Okay.
So this was prepared probably a week ago. That's where we were then. Things have changed since then a little bit. I do have updated numbers if you want them, but because of the online stuff, I didn't think I should hand something else out, talking about something different. Not significantly different, but at this point, the bottom line, excess levy requested over what we're allowed is about $1.7 million. We've been updating, it's coming in about $1.6 million now. We've gotten some additional information from a department or two. So we're just in the process of meeting with departments now. I'm sure in the next 2 or 3 weeks, we'll get through all of the departments, kind of start putting the budget together. What can we do to make changes? We haven't really gotten very far into the budget. To use a baseball analogy, I'd say we're in the second inning right now. We're just kind of getting going, put it together, see where we're at. Now we'll start working the numbers a little bit.
Is that a 9-inning game or something?
Yeah.
Okay.
There's like human services, you see a large increase there. A lot of their increase there is for including in the budget for Mendota, which is the facility down in southeast Wisconsin. They're projecting needing to find some way to budget for that particular facility. They do have some individuals in there now that could be impacting our budget. So we're gonna have to take a look at how we can possibly fund that one.
Is there any response from the counties dealing with the state to get some funding from them? Is that going anywhere?
Tom, are you,
I'm sorry.
I don't know that, you mean WCA? I'm sure they're working with legislators on funding for human services. I'm not sure myself where that's going.
From Mendota?
Okay. We talk to them all the time. There's nothing in the works that would relieve us of the responsibility of paying for that at this time.
Mike and Tom, if there are any people in Mendota who are not property taxpayers in Sawyer County, can we talk to others to help fund?
No, it is, my understanding is it is a statutory requirement that their place of residence establishes who pays for the person down there. And so there's,
Right. But what about approaching, the other entities in the county to see if they would voluntarily help fund some of this?
Well, we can talk to human services about that. I know they're doing everything they can. As I understand it, there's 2 individuals now that are there more or less on a full-time basis. There's always, I guess, people kind of in and out.
Right.
There's 2 full-time right now. They've exhausted all of the health insurance. They're at their lifetime limits.
Right.
Medicare, Medicaid, we're finding out. I didn't even know there were lifetime limits on there, but they've hit those lifetime limits.
Okay. So, but maybe we could have you can have a discussion with Tweed or something to see. He's on the Health and Human Services, isn't he?
yes.
Okay, yeah.
So anyway, that's something we're going to have to work through on the budget.
What's up with the rec officer?
So that's really just a shifting of a position out of the law enforcement budget over to the rec officer budget to try and bring in a little bit more revenues in the rec officer.
Okay, so there's a corresponding decrease in the general fund.
There is, yes, we moved a position.
All right.
Highway, a couple of things, I think they're trying to reestablish some levy that maybe was reduced in prior years. And I know there's a bridge project that they're trying to get alternative funding for, but until they do, they've got it built into the levy at this point. So that's where we are.
So this is my own personal opinion, is that we approved short-term borrowings to fund the 2021 budget deficit. But personally, I cannot see that short-term borrowing increasing property taxes no more than 5 to 6%.
Right.
So somewhere along the line, I don't know how these numbers wash out. We're going to have to reduce capital or reduce the operating budget so that we come within that 5 to 6%.
Yep, we're aware of that. We're working towards that. I think by the time we get to the September Finance Committee meeting, we'll have a lot better idea of where we're going and what things are looking like. Like I said, we're just kind of getting into it now.
No, understand. Yes,
So keeping it 5 to 6% increase, you're gonna have to spread it out over a few years then? Is that what you're saying, Bruce?
yeah, I think,
Short-term borrowing?
I think if we move some of the dam expenditures, and I think Mike's done that, move from 2021 to 2022, then we could spread, then the property tax increase for 2021 would be about 5 to 6%. Then the property tax for 2022 would be about 5 or 6%. But, you know, those are rough numbers. Mike is refining them now.
And we'll get into more of how that works as we go through the presentation here, but, and we got some information from Jay yesterday. I mean, this is ongoing discussions here, but, you know, as Mike continues through the plan, you kind of see how some of that lays out.
Okay.
So, you know, we're aware that we need to get that way down, and
Okay.
and then down below, we've got what's been requested for the special purpose levies at this point. You know, the library's pretty much stayed the same, little reduction. Ambulance is up a little bit at this time, but we've not really met with them yet. The bridge aids, that one is just an estimate at this point. I guess the deadline for highway to hear from the townships is August 15th. So that number could change. It's just an estimate by Gary at this time. So that's kind of where we are levy wise. If there's no questions, then we can move on to the capital project summary, which is 7B. This is still in process. I've not completed this report. I have all of the requests on here that I'm aware of, but I still need to look at beginning of the year fund balance, what's available, and how that might help with the budgeting process for Kent area. I've also, if we're looking at page 1, which is the summary of all of the departments. Again, I haven't really worked this through with Tom yet, but you'll notice on there, there's under the revenue section, it says proceeds from debt issuance facility. There's $7 million. At this point, it's just an estimate. I don't know the timing of when we may build or when we may borrow. This could change. I do. Built in that we would spend about $2 million next year towards the courtroom project, and then the balance would carry over into 2022. But again, that's just an assumption on my part.
So the $7 million debt facility is a fund, it's up to fund the new large second courtroom.
Yeah.
And then the proceeds from debt issuance, that's the short-term borrowing to fund.
Yes, so at this point, I have that 343,000 highlighted.
Right.
At this point, that's what we would request for the short-term borrowing. Now, again, we have not kind of scrubbed the numbers, if you will, on this. I think there's some options. We can get that number down a little bit. But that's where we are today.
And EMS, you know, the question is, why is that up so much?
Again, there's really two items driving that number. Every year they budget for an ambulance, which is somewhere around 140,000.
Mm-hmm.
There's also a new requirement that I'm not sure if the date, if it's January 1st, they have to upgrade all of their cardiac monitors, which I believe is about 6 of them. And so that's at a cost of 140,000. And so those two items, plus there's something else, I don't remember what else is in there right now, but
You haven't met with them, right?
we have not met with them. We've just received the information at this point.
Okay, all right. So the requirement for the new monitors probably comes from the state.
I believe so, yeah.
Okay, and
Might be federal, but
federal, but nobody offered us any money to help with that.
Not that I'm aware of yet, but like I said, we haven't.
All right, no, I understand.
Mr. Chairman, Mike,
Yeah.
where are you at reading these numbers? What page on there?
I'm looking at, well, it says 5 of 28, the summary page.
Okay.
It's
Seven-
agenda
7B.
7B.
Oh, got it, okay.
Okay.
So again, I'm just kind of working out the summary page at this point.
So the takeaway from this capital project summary is that these are what you have and you haven't worked the numbers. We haven't worked the numbers yet.
Correct.
Okay.
We are planning to shift, like you said. Previously, we had allocated $224,000 of operating levy to this fund to help pay for some of the items, in addition to fund balance. We're kind of going away from that model right now. We're not using so much fund balance. We've reallocated the levy, the 224,000 out of capital over to the operating general fund side to help the levy deficit on that side. So that's kind of the theory we're going behind at this point.
Is that what you wanted to say about the capital projects?
Yeah, yeah, it's still, like I said, I need to take a look at what's budgeted this year in capital. Where are we at spending wise? Are there projects that are complete that maybe there's some excess fund balance we can lapse towards these? I'm in the process of doing that now.
All right, so our takeaway from this is more to come, or?
Yeah, this is like the first budget sheet. This is where we are now. Now it's
Okay.
time to start digging in.
Okay. And for the short-term borrowings, can we see a draft of that resolution next month? We're not gonna have numbers in it, but
Well, we can talk about that when we get to agenda item 9A.
9A, okay, that sounds very good.
Okay, so any additional questions on the budget or? No? No hands raised? Okay. All right. Item 8A, cash flow analysis. With, the slowdown in the economy as a result of the COVID-19 situation, kind of monitoring what are the impacts of that on the county budget. We know there's revenue decreases that we're seeing. Everybody expected sales tax to decrease. We're not seeing that yet. Hopefully we won't see it, but we are seeing it in some other line items within the budget. There's some areas where we're not spending as much. There's some areas where we're spending more. So we're kind of monitoring all that with the eye on what is the impact of all of that on our cash balances. Are we in a good cash balance situation? Do we project we're going to be in a good cash balance position? The other thing that will have an impact on cash balances is the real estate tax collections. We just got through second half collections. Were we collecting taxes on pace what we had collected in the last few years, or because of the drag on the economy, were collections reduced from where we might have anticipated them to be? So we put together, actually PMA, which is a financial advisor firm, put together for the county a cash flow analysis. And we'll talk about PMA when we get to agenda item 9. We'll kind of introduce them to you that way. But they were kind enough to put together a cash flow analysis for us using data that we provided for them. And we also gave them some scenarios or assumptions to consider in the different scenarios they're putting together. So the assumptions we gave them was make a calculation based on how our budget is and how we are year to date compared to budget, where we think we're gonna come out. Scenario one was, what if sales tax comes in with a 1% reduction and revenues come in with I think it was a 1% reduction we used. What would the impact on cash be? Scenario two was, what if sales tax comes in with a 5% reduction and all other revenues are at a 3% reduction? And then scenario three was, what if sales tax comes in with a 10% reduction and all other revenues are 5% reduction? What would the impact on cash be? And that's what page one of their report shows, the different scenarios. January through June shows actual cash balances for those months under each scenario. But then July through December kind of shows what the projected cash balances would be each month and at the end of the year under the different scenarios. And then there are charts and graphs below kind of show what those cash balances might look like.
So even at the worst assumption, we still will end up with more than $7 million of cash. If I read this right.
Correct. So the very first row up there shows what cash was at the end of 2019. That's at $8,030,000. That was our cash position coming into this year.
Mhm.
Then under each of these scenarios, you do see what the projection shows. Our best case scenario is we would come in greater than our 2019 cash position, because we know that our unassigned fund balance is trending in a downward direction, and we'd like to kind of reverse that and build on that balance. And to do that, we need cash position to come in ahead of where we were. And I think we're all, to this point, surprised how well sales tax has done, really. I mean, our collections have been greater than they've been the year before,
Right.
to date.
Right. I know that Amanda Wilson, who owns Deerfoot Lodge, said they've never been so busy.
Yeah.
With the Canadian border closed, people aren't going to Canada fishing, and the people in the big cities want to get out of the big cities and move here, or not move here, but
Right.
vacation here. So hopefully at least the resort sales tax number should get better.
That would be a pleasant surprise. The one line item that is taking a budget hit is our interest on investments. That line item, and we'll see it in a little bit here, but that line item is way down.
Not a surprise.
No. So that's page one of the report.
So what's the takeaway then from this work?
Well, this just shows us, kind of a range of scenarios and what the impact might be on your cash balance. So as we continue to monitor this through the end of the year, if we see our revenues trending down somewhere in the range of these percentages or sales tax, we know what the impact on cash might be. Hopefully it's an indication for us that maybe we need to change something now while we still can to have a more positive impact on what our cash balance ends up being at the end of the year.
So this is more a tool for you folks, for this admin staff to monitor and recommend corrective action.
Yep. Exactly.
Okay.
Mike, what scenario do you see us right now, what you've seen thus far?
Well,
You said you're pleasantly surprised. Does that mean we're up somewhere around one or?
I would say right now, and this is just an assumption on my part, but I would say we're closer probably to the scenario one right now. And I say that because we know sales tax is holding its own. There are some revenues that are down. But when I look at the general fund activity year to date, as of June and as of July, this year compared to last year at that same point in time. Overall, the budget's holding its own right now. Highway is right now looking budget-wise pretty good. They're holding their own. The concern a little bit would be for Health and Human Services at this point. That budget, for some different reasons, is a little bit behind where they were tracking a year ago. You know, the Mendota is impacting them. They're incurring a lot of expense right now addressing the COVID-19, the public health people. And they have different grants available to them to help offset some of those costs, but they're just now starting to report to the state what those costs are. So we haven't gotten them revenues in yet. So that's impacting their bottom line a little bit. And because they're also spending so much time with the COVID-19 in the public health area, it makes it difficult for them to do some of the other grant funding areas that they've historically done every year. They're just not having the time to get to those areas yet. So we're not sure how that's gonna balance out in the end either.
So the COVID money from the state, we have to justify and spend it before they'll reimburse us?
Yes. Yes, and there's different pots of money. Health and Human Services and Public Health has some of their own pots of CARES money from the state. And then we have the routes to recovery on the overall county side. But under both scenarios, you do have to spend the money first in order to receive the money. So
Are you taking into account forestry and that with those Verso mills closing?
Yep.
We heard yesterday that maybe, right, maybe we're gonna hit our budget.
Yep,
well, and that's what Bruce has been, or Greg has been telling us too,
Right.
that because of the mix of the wood that we're selling and how much we do or don't put to that particular mill, the impact shouldn't be as great as maybe other counties are seeing.
right, yeah, that's what Greg is saying. I mean, he said like, you know, that barring unforeseen weather events, he was reasonably comfortable that he could make the 1.8 million.
And we are, again, you'll see it in a minute, but we're tracking ahead year to date collections this year over last year for timber.
Yeah.
Now, a lot can change, I know, but
Right. Okay. Now we're gonna get to the COVID-19 account tracking at some point too,
Yeah.
John and Tim, right?
Yep.
Okay, so takeaway on cash flow analysis, it's a tool the administration is using to monitor, and if anything pops up, you'd come back to the committee with recommendations.
yeah, I think so.
Okay. Any more questions on cash flow analysis? Nobody online?
Tom, did you want to comment?
Not yet, no.
Okay. Then we can move to number 9.
Tom, you want to start that one?
Yeah. Cindy, Brian Della is on the line. Brian, can you hear us? And I don't know if you're unmuted or can speak, or can Cindy promote him?
Who is Brian?
Brian Della works for PMA. That's the financial planning outfit that Mike alluded to earlier. We work with and have worked with PMA on the treasury side for a couple of years now. Diane Ince uses them for some investments. So we do have some investments at the government pool. We use PMA for some investments and then some CDs. So in working with Sarah on the investment side, that's who helps there the cash balance analysis. Brian Della works on the debt side. We've been talking with him on what our objectives are as we go into this different scenario of issuing debt for other capital items that we have not previously issued debt for. So we had that discussion amongst the board and Finance Committee and the board authorizing us to utilize debt planning within the budget planning session. So as Mike has laid out the plans, that includes that debt for capital items Brian Della, who we've been communicating with to help us through that process as far as, issuing the debt, especially as we get to the debt for the courthouse and all that's entailed in that. So
Have we engaged them as our financial advisors?
Well, and this is the introduction, we wanted to get this in front of you, but we've talked to a couple of firms, and I've dealt with Brian before. We use PMA on the treasury side. We're comfortable with them. We've also looked at Ellers, John Lentz, who does some work at the city. Talked with him. The gentleman that helped us before, who used to work for Springstead, and then they got bought out by whoever Baker Tilly is now. I think he's somewhere else, but Brian has done similar work. He provided some information on another county that's very similar to us in the objectives that we have, and we felt comfortable going with Brian, but we wanted to have some discussions with you and lay out the next plan that you have in front of you. Just kind of lays out some of the debt planning tools that we'll be using into the future. And I'll turn it over to Brian just to kind of explain, about him and his firm and, what we've been talking about recently. So Brian, if you can hear us, the floor is yours.
All right. Can you hear me okay?
Yes.
Okay, great. You never know, right? So thanks for that introduction. As Mike said, Sarah works on the investment side, Sarah Schnorr, and I'm on the debt side. I had the opportunity to talk to Tom and Mike about some of the budget issues that the county is going through, and some of your increased capital needs. And I told them we could put a model together, and I think it would, hopefully that the staff and the supervisors would find it intuitive and valuable to do some long-term planning. What you're looking at now was dated July 24th. So, I guess I would just say, please consider this, these numbers, the actual numbers should be correct, but the projections are just what I thought were some reasonable estimates at the time. These numbers obviously have changed since then, and they're still not final. But the idea is, if this model makes sense to people and is conveys the right information, then the model can just be tweaked going forward. The way the model's set up is we take we split your levy into two pieces. The green is what we consider the operating levy, and that is essentially everything that's not debt. So the area to the blue is your debt service levy, which includes your two existing issues and some projections I've made based on some capital projects right above it. And everything else we have placed in the green under operating levy. So the numbers you see there in green, you would be able to tie those back to your financial statements. They're almost all, not entirely, but essentially, they're almost all subject to levy limits. There are some special purpose levies in there that I don't think are subject to the levy limit legislation, but the vast majority is. So when we have the 3 years of actual, and then there's a projection going forward, that projection reads an annual increase of 0.7%. So that 0.7% is an estimate of the county's most recent net new construction. So the operating levy, you have 3 years of actual, and then it grows at 0.7% forward. Of course, when you get, budget numbers for 21, we'll just put those in there, and same for the years after that. So as you slide over and you look at the debt, the first two issues in the light blue are your existing debt issues, your 2012 bond issue, and a small bank loan you took out last year. And early on, and I know these numbers have changed, but if you look above, we've got some capital projects. And, we talk about the idea is that you'd borrow the capital projects. The first year is a 2020 borrowing for 2021 projects. And the reason you borrow in the fall is that so you can figure out how much your debt service levy is going to be for the following year. And you can put that or really how much your debt service is going to be for the following year. So you can put that debt service levy amount on the property taxes. So we understand that that just because you're eligible to increase your levy by any new amount of general obligation debt, that doesn't mean that the policymakers are going to accept any. There's obviously limits on how much people want to raise the overall tax levy, and that's what, as you go from left to right, and you can see the different bond issues or note issues, you can see in that dark blue square, it says total debt service levy, and then the following column is total levy. So, what this model is doing is we're making estimates of your operating levy, we're making estimates of your debt service levy, we're looking at the total levy, and then we're looking at what's the annual increase. And it's an increase for a while, so I guess it could be a decrease someday, but not in the near term. So what's the annual increase in the total levy for the for the property taxpayers? Because that's really that's really the bottom line for people who pay taxes and for policymakers. And I'm going to get back to the debt in just a second, but when you look at that total levy column, the year over year in percent change in total levy, that's on the dollar amount of the increase. So we're assuming that that there would be probably 1% growth in equalized value within the county. And so, your rate would grow at a slightly lower, your rate, the levy rate would grow more slowly than the actual dollar amount of the levy, because you've got some increased equalized value to spread it across. So now let's, let me just say on the total levy column, that year over year change, the first year in this example, and it's just an example, and when you firm up your capital numbers, we're going to have to tweak things through. But based on some rough numbers that I had, I was able to construct a levy that grew by 6.6% the first year, 2.5% the next 4 years, and then it just basically had a very modest increase, solely based on an increase in the operating levy of about 0.7%, because we had set this up so that the debt service stays the same in a dollar amount. So now I'm going to go back to the middle and just talk about the debt service levy. I think that there was an initial discussion in the, with policymakers and staff about doing some short-term borrowing, kind of maybe in that 6-month range. You issue it in the fall, in the spring, you pay it off, which can be used effectively, just sort of depending on your existing debt and, the amount of capital that you're looking to finance every year. So when I started setting up the model, I realized if you want to have more predictable and more modest changes to the overall, the county's overall levy, then you might need to spread out the payments instead of just a one-year payment from fall to spring. You might have to have 3 payments, so over 3 years. So, and this is all just a little bit of, you got to play around with it, and you've got to, it just takes, it's a bit of an art at that point to try to structure all your debt issues to meet these requirements. But, if you look at the first debt issue, I've got $1,680,000 in projects, and that $1,680,000 would be paid back over 3 years. The following year, we have a little less. It's only $1,180,000 in projects, and that would be paid off over 3 years. The following year, and this could easily be moved up, but I just put, and I think I'm a little light here. I had $7 million total between the new courthouse and your other capital projects, including highway and dams. I had $7 million total. I think it might be closer to 7 million just for the courthouse. But because of the courthouse component, that would be a 20-year borrowing. So I showed a 20-year borrowing there. And then as you can see, the next year, if you're only borrowing $1 million for general capital, instead of paying that off over 3 years, you can pay it off over 2. And then the following year, we have $1.2 million in there, and you can pay that off over 2 years as well. So, based on this capital borrowing plan that I had, a few weeks ago, you could start by just issuing 3-year notes, presumably with a local bank. You could do a capital markets bond issue. Then you could start to do some 2-year notes. And then you could get to that point where you could borrow, $1 million to $1.4 million every year and get on that for projects and get on that sort of 6-month note with whether, you're going with a local bank or the state trust fund loan program. That's a issue in the fall, paid off in the spring, put it on the debt service levy, and you can really effectively, quite simply manage the amount, your total levy. When I think this, from what I gather, I think we're gonna have a little bit more in projects. So I think that, right now this, when we do another turn of this, right now it's at 6.6%, 2.5. Maybe if the policymakers say, well, we don't want anything more than 5.5%, that'd be fine. The next couple of years might be more like, okay, those will be 3.5%. You've got to get it somewhere. But I hope you'll find that this is a really reasonable and, sort of plan that meets your capital needs. And I think it's, it shouldn't cause, too much heartburn from property taxpayers. And I think it's, easily explainable on why there actually is an increase because of the increased capital. And then, of course, some people love numbers, some people like graphs. The graphs at the bottom show on the left, it shows the total levy, operating and debt service, and how it's kind of growing, modestly over, between, over time. There's 3 years of actual, and then, I guess 6 years of projection. And then the same thing on this. You have 3 years of actual on the change in the amount levied and the dollar amount levied. You've got 3 years of actual in light gray, and then you've got a projection here in the dark gray.
Question. I have a question regarding, I thought the payback, instead of stretching over 3 years, I thought we were going to pay back the following year. Why do you want to stretch it over 3 years?
Well, the reason that I took the liberty to stretch it out over 3 years is that, and this is typical, I had assumed there would be a more sensitivity to a spike in the overall county's levy rate. I mean, right now, if you do $1,680,000 in capital, if you spread it out over 3 years, you can have a very, a much more modest increase in the county's tax levy. If you pay it back in 6 months, there's going to be a considerable spike in the county's tax levy, which would probably force the elected officials to just not to go down that road and be forced to cut back capital. Here, this allows you to do the capital that you've identified is necessary, and without having a large impact on the property taxpayers.
So this is Bruce Paulson. I'm looking at the schedule, the 2020 borrowings for 2021 projects of $1,680,000. And then I'm looking at the first, I guess, dark blue column where it says 2020 notes. So we're spreading over 3 years. If I read the schedule right, our taxpayers would be paying just about $81,000 in interest. Is that right?
That's what this shows. Yes.
Okay.
Now,
First-
I like to, I kind of like to, there's a little cushion in here. So I think you very well, if you went to market, could have that number be lower. But I would rather, for the sake of a model, err on the side of higher interest. I mean, this is October principal. I mean, simply by moving it to May, you'd save 6 months of interest every year. I mean, that number would go down in practice, but like I said, I'd rather just show a number that's a little higher, and then quote unquote beat that bogey when the actual borrowing takes place.
Mr. Chair?
Yes.
Yeah, just a couple of comments. We did talk about, the 6 month kind of borrowing, or 2 months, within the year anyway. And that's where we started with Brian. And of course, the obvious advantage to doing that is paying much less interest cost on that borrowing. So, what Brian has laid out, kind of smooths out the tax rate increases, but at the expense of added interest. So we've, had some back and forth with Brian on, the advantages and disadvantages of doing it that way. I think the important thing, rather than hung up on, the numbers that are in here, because the numbers have changed, and even that, first year borrowing, I think is going to be far less than what was, on this sheet from 3 weeks ago. I think the value of this, if we use this every year, this will lay out the plan going forward. It's kind of like the capital improvement plan that we started, laying out the 5-year capital improvement plan. This is like our debt service plan. So, I think what's in front of you now is going to be a good plan, but I think for the policymakers, it's the either or kind of situation. If we do the 1 year thing, you may have ups and downs in the tax rate. If we try and smooth it out, it might be more palatable for the taxpayer, but it comes at the expense of higher interest costs. So, that's kind of what we wanted to bring forward, for you to have a conversation on is what direction do you prefer to go, and we'll structure it that way using this as a tool. And Brian can help us with that. But I think part of it is just kind of that conversation of what you would like to see and how you would like us to proceed with that.
So what would be the interest expense if we borrowed and then paid it back in two months for 2021?
Well, I don't have that number, but I mean, it would,
5,000?
well, I was gonna say conservatively, what if it's 10,000?
Yeah.
But, right, that's the difference. Tom's exactly
Right. I mean, no, that's what I understand. So I'm trying to draw it out is that it would cost our taxpayers 3 times, 4 times more in interest expense than if we went to the short term.
Yeah, the other thing, just to reiterate what Tom said, you know, the year one, the 2020 projects, the amounts identified there, that 1,680,000, that's probably pretty high.
Right. But I
That was
mean,
just based on, at that time, that's what we gave Brian.
right.
Tom and I both think that that number is going to come way down.
But
I
it just,
mean, even if it was, let's say the projects for year one come in at 50% of that, if you looked at 50% of the interest rate,
Right.
so now you're talking maybe $40,000 in interest versus
right, but I
5 or
mean,
10.
the policy issue is, do you want to borrow short term
Right.
and pay a small amount of interest for 3 years and pay, and I'm gonna guess 4 times more interest. It could be 4 or 5 times more interest. I mean, that's what we've got to decide.
Right, and the short-term borrowing, you save on the interest, but you're gonna, like Brian said, you're gonna spike the tax rate.
Well,
Taxpayers are gonna freak out.
Well, we don't know the numbers yet, we don't know.
right, but I mean, that's why I'm saying we need to probably be managing our capital and our budget so that we don't spike it more than 5 to 6%.
Great.
And that's what the plan does. But
I mean,
that's what this plan kind of lays out.
it does, except that if we're paying, 4 or 5 times more interest, we're charging the taxpayers 4 or 5 times more interest. I mean, to me, that's the trade-off.
That's the balancing.
That's the balancing, and that's what we, the county board or the finance committee recommending to the county board has to decide.
Yeah, and if I'm reading this right, Bruce, then 1 year, we're gonna have that 5 to 6% increase, right? Just 1 year.
Right.
And then we're going to 2.5 for
Sure.
3 or 4 years. And then we're gonna go back down to like 0.6,
Right,
correct?
that's the way I read it.
Yeah. So we're gonna have a 1 year spike of only 5 to 6%, which we're still gonna hear about it, but
Right, but we are
it's more
trying to,
palatable. What would the percentage be if we paid all that interest off in the first year, or 6 months, or 2 months, or what you're talking? Would that be in the teens, 10, 12, 13%?
well, but it would be, but the other option is to move some of the capital projects out further or just control the budget expense. This model here says we're going to be, we need $908,000 to balance the budget. And so my thinking is, let's cut that amount down so that we can, borrow less.
Well, we know that's going to happen. We just don't know what that number
Right.
is. Yeah.
But rather than discuss the specific numbers, I think we have to decide, maybe not this meeting, do you want to charge the taxpayers, I'm going to say 5 times more interest expense to levy to maintain, I guess, a lower tax levy increase? I mean, is that not the decision point? Correct. So, I mean, I like the model. I mean, to do this debt planning, I mean, I think it's great. It's just we have to decide on the policy issue. So is this just an introduction?
This is an introduction to the plan, so no matter what way you want to go with it, we would use this kind of format as our document, planning document in all future years as well.
Right.
So, and as Mike said, as we kind of get better numbers, this model will obviously change, and we can, we'll bring this back and show you, with the new numbers, what it looks like. We went into this thinking that we would pay it all off in the next year, and we can, certainly do that. We just wanted you to be aware of the options, because, we can make it smoother at a cost, or we could maybe have some fluctuations and overall save money, but have the fluctuation. So, what do you think the taxpayers, taxpayers obviously don't want any increase, but if we do have an increase, what's more palatable?
I mean, the numbers may change, but the policy doesn't change.
Correct.
So I like the numbers, and I like the way you put together the chart, but I'm not spending more money than I have to, so I'm gonna go with the 6-month turnaround and pay the debt off. Not 3 years. My opinion.
No, I understand. I share the same concern. But we'll refine this as you get the numbers, get your budget deficit numbers and your capital improvement projects.
Yeah, and we can do, smoothing as you suggested, just by trying to move some capital around. And that's where the capital planning becomes more important.
Absolutely.
And we get the department directors to think more of the long term. We're still getting a lot of this is what I need next year kind of thing,
Right.
instead of looking out 5 years, so that we can more evenly plan out those large capital expenditures,
Right.
as we coordinate that with the debt plan.
No, I understand. So where are we with this? This is just information. You're going to come back?
Yeah, Brian, based on the comments, do you have any additional comments on anything for the committee here?
Just 2 points. That if you were to, I guess what I would say is this, construction cost inflation tends to be higher than your borrowing rate. So if you're looking at, these are the projects we want to do, and you then say, well, we only want to pay it off over 6 months because it's to minimize the interest expense. We need to delay some of these projects because the spike will be too high in the county's levy. That you will save interest expense by that, but with construction cost inflation, when you delay projects, you will have a higher project cost the following year or the year after that. So you've really got to balance construction cost inflation with your cost of borrowing. And the lower your cost of borrowing, the more advantageous it is to borrow. You might see more interest expense, but you need to appreciate that by getting it done sooner, you're not subjecting your project to an annual construction cost inflator. And like I said, and the second point is to reiterate a point I made earlier, is that, on this interest expense on these little bank notes, I just, put a number in there that it was a little higher than reality. So, we can tweak this to show, spring payments, and you could talk to one of your local banks and see what a 3-year note they'd be willing to lend it to you. So the next turn on this, could have May 1st payments with, at 2% or something even less than that. And you would see that interest expense go down, at least for this year's borrowing. I mean, it's tough to predict the future, but, if you look at the financial markets, if the 10-year U.S. Treasuries, at less than 0.7%, clearly market participants think short-term rates are going to be lower for longer. So you should have very attractive short-term rates for a number of years, and quite frankly, that 20-year borrowing should be very attractive as well, because we're just in a long cycle of lower borrowing costs.
Right. No, I think that's valid. I mean, if we went to the short-term borrowing, I think the state would charge us 2.5%. Pardon me?
Yes.
Right now. So, I mean, we do have that interest rate spread then between 2.5 and what the interest rate would be if we went the 3-year route. I mean, that's correct. That's true, isn't it?
Yeah, I don't know what the interest rates would be. I don't know what the local banks would offer.
What did we get on the ambulance? What was that, 2.08 or something?
I can't recall. I don't want to guess.
Yeah.
I'd be guessing.
Okay. But there is a spread, I would say. Okay. All right, any more questions, comments?
Brian, we did talk about the resolution that is required to adopt the debt. Were you able to provide an example of that yet? And we'll probably come back with something even, maybe even ready to go in September, based on the timing of, if we can get from here to there by September.
Sure. So, you know, there's going to be two resolutions for these, at least this 2020 borrowing. There's an initial resolution that just authorizes the debt. A not to exceed, the county board authorizes a not to exceed 1.7 million or 1.5 million or 1.3 million in general obligation promissory notes. And that would require a 3/4 vote.
Mhm.
And then when you go to presumably a local bank, and they get you either a 6-month note or a 2.5-year note, there'll be a resolution on that day when the sort of final terms and conditions of the borrowing are finalized, and the county board accepts that.
That's a 50 majority vote?
That's correct. A majority vote on we'll call that the day of sale or setting the final pricing resolution.
Okay.
So of course, if, and I don't think you're going to go this route, but if you go to the state trust fund loan program, they've got all the forms set up already. Now, of course, it just doesn't seem like that's your cheapest option and with the most flexibility, but just as an FYI.
Okay.
And of course, these initial resolutions with this 3/4 vote, they're good for quite a long period of time. So, to the extent that you want to authorize the new courthouse bonding, you could do that, sooner rather than later if you were comfortable with, just having a not to exceed amount that isn't, sort of particularly firm. That doesn't really authorize the method of sale. On a bond issue, usually come back and you might authorize with a 3/4 vote for 7 million, but it doesn't actually give you the authorization to directly issue the bonds yet. There's really called a set sale resolution, and at that point, there's more details about when you want to sell the bonds, how you're going to sell the bonds, the exact dollar amount. So if you authorize, say, 7 million for a project, and then the bids come in at 6.8 million, and then you estimate you could probably earn $50,000 in interest or something on that 6.8 million. Well, then now you're down to only needing to borrow or issue $6,750,000 worth of debt.
Right.
So whatever you authorize under the 3/4 vote, that's a maximum, and you can always issue less. And when it comes to bonds, you would have to go to a new resolution anyway. When it comes to notes, you would just just 2 resolutions are required.
So, Tweed, I think our thinking was that when we approved the courthouse option, at the same time, we would approve the borrowing not to exceed in a separate resolution. Did I understand right?
Yeah, that's what I understand.
All right. So we should have that not to exceed debt resolution ready when we go to the board for the second courthouse option.
And that's the first resolution that requires a 3/4 vote?
Yeah.
I think that's the safest way to do it because
I would
then
agree.
you're,
Right.
as you authorize, proceeding with the courthouse and the planning for that, we guarantee then that we're going to be able to issue debt or not, depending on how the vote goes, and then we'll.
Okay, so we need that resolution somewhere within, I don't know how long, or it's probably hard to say when you and the city are gonna finish your negotiations.
Yeah, we discussed that a little bit in the closed session last evening in Public Works, and we'll continue that discussion with the board next week as well.
Okay, all right. So we'll plan the timing for that draft resolution then. It's.
Yeah.
Okay.
So moving forward, it sounds like for the September meeting, we need that resolution ready to go, but we will finalize what the term is, whether it's a 3-year or 1 year or less at that meeting. Does that work, Brian?
Yeah, so when you authorize promissory notes, those can be up to 10 years in length. So just from an authorization process, it'll be open-ended, and the supervisors or the committee or however it's going to work out can work with staff and PMA to determine exactly how you want it structured. And then, that doesn't need to be included in the resolution.
Right.
The resolution will be more generic. You can authorize, X amount of dollars worth of geo promissory notes. And you can, it doesn't need to have the details of whether it's a 2-year payback or a 5-year payback or a 1-year payback. That can all be done late. That can also essentially be agreed upon later out of committee.
So
It just has to include the amount not to exceed,
right,
correct?
right. So I mean, when we see the draft resolution in September, the amount not to succeed would be blank, right? Or you won't have that number yet, will you?
Well, I don't think we'll be final then. I think we'll have a better idea, and we can set a not to exceed,
Okay,
being somewhat
right.
conservative.
So if we do choose an option, then we can put that number in when we make that motion not to exceed,
Right.
correct?
Yep. And then if I understand correctly, after the board approves that, then the admins, the staff working with this committee could decide how you want to issue the debt, whether it's 6 months, 3 years, 5 years. Did I understand that correctly?
Yes.
Okay, Miss Kingsley.
That's what I hear you saying, but why would you not want to put the time frame in there, please?
Well, if you know exactly how you want it structured, you can put it in there, but it's just not a requirement. So I think that it just I don't know what to say. It's just not it's not a requirement. You're more than welcome to do it, but this would allow you just to get the resolution passed sooner rather than later, if that's an objective of the county.
Thank you.
I think, Mr. Kinsley, I think the more detail we put in there, the tougher it's going to be to get a 3/4 vote.
I want to know what I'm voting on,
Right, I agree.
or that's the other side.
Right,
That's all I feel.
yeah, no, I agree. Okay.
So Brian, just timeline a little bit for my benefit. So we take a resolution to September County Board. Assuming it passes, going forward, the November County Board approves the budget. I have to have the levy limit worksheet to the state by December 15th. Do we have to have the proceeds before that December 15th or?
So yes, you would, you should just, you don't have to have the proceeds, although that's usually when, essentially when the terms and conditions are finalized with the bank. But
I need to know the final numbers by the November county board though, don't I? No,
Yeah, no, you should, but, I mean, yes. Now, for some reason, if the, if the funds, if you had an agreement with the bank and you just haven't closed on it yet, that's okay. We would know the numbers.
Right.
And we could just put it in there, if the bank says it's gonna be at 2% and everyone, and the proposed amortization schedule, whether it's one payment or 3 payments is agreed upon, then, we'll know the number for you to fill out the form. Hopefully, and I'd see no reason why we couldn't get it done fairly quickly. I mean, banks move quickly.
Right. Okay.
I mean, you could have it set up in October, right? If you authorize in September, if the board knows how they want to structure it, there'd be no reason you couldn't get it done. If you authorize in September, couldn't have it done in October.
Mr. Chairman,
Yes,
we have to publish the budget after the October meeting, correct? It's got to be published in the paper X amount of time before the November meeting.
Yeah, 2 weeks.
Yeah.
So this one has to be done in October. So my thinking in September, you want to finalize, you're going to estimate what the dollar amount you need so that you can plug the numbers in for October's meeting.
How was your tour?
And you can always adjust it in November if you have to, but you have to publish something in the paper. That's how I look at it.
yeah. So for September meeting, we've got a couple of variables. We've got the construction inflation variable. We've got the interest differential from borrowing from the state versus refining the borrowing from the banks or the public. Yeah, so can we have some numbers or some guesses on what that, that bogey's going to be?
Yep.
Okay, and then we can decide what we want to do in September with the borrowing, and then go to the board saying, okay, this will levy the tax increased percentage, but it's going to cost us X dollars more, and it costs the taxpayers X dollars more in interest. Or go say, okay, we're going to do short-term borrowing, and the tax rate's going to spike X%. Okay.
Yes, I think that's a critical date.
Yes, did you have a comment?
Yeah, just a comment, this is a good discussion on the timing of things. I think, where we're at in the budget cycle, we're actually slightly ahead of where we've been in the past, which is a good thing because we've also got several more variables that we're having to deal with trying to estimate what's happening with COVID next year, this new debt strategy, how that works in there. Brian talked about the timing of things from the perspective of issuing the debt, but there's also the timing as far as making sure that debt qualifies to be outside the levy limits. And so we've had discussions with DOR, on the timing of that. So all these kind of variables kind of play into that timeline, and we're trying to keep track of all of those.
Okay.
So, Mr. Chairman, I got it right then. In September, we would like to choose the option and pass the resolution to issue debt with a not to exceed a certain amount, correct?
That's what I'm thinking.
You too. And then in October, it's going to come back to finance, and you're going to bring a recommendation to the full county board on how the payment plan should look structured. Is it a short-term debt, or is it correct? Or are we going to pay it off over time?
Right, that's what I'm.
And then we can decide on that at the October board meeting.
Correct.
And then we can publish it, and Mike will have a better idea what to put in paper. Correct?
That's what I'm thinking. But
Tom,
Mike, does that work with your timing?
Yeah, and what we publish in the paper obviously is the budget at that time, and then there's also further discussion, public comments, other discussion with the board. So that's not the final number, but it's the number at that time that we'll publish and have discussion on. So.
Okay.
Mr. Chairman?
Yes.
Troy here. In terms of either the spike or the leveling off from the tax levy standpoint, is that something we would like to recommend now so that the board can discuss it in August, or Or should we, or is that going to be on the agenda to discuss? Because it seems like that's one of the bigger decisions before
Right.
we move forward. Is that something we should, you know, find, you know, what this committee would recommend, or do we want that to be an entire board discussion?
Well, my suggestion is that we got a couple of moving parts. We've got what we talked about, the interest differential between short-term borrowing and longer-term borrowing. We should take a look at the capital cost inflation. And my preference would be to have something more definitive before we go to the board, rather than saying, do you want to borrow short-term, or you want to borrow long-term?
Right. Okay.
Because these numbers are going to change.
That's what, yeah. That's what
That
I-
sounds good. Thank you.
Mr. Chairman, I like Troy's idea there, though. In the August meeting, if you, during your finance chair report, can kind of lay out what we're looking at, and some of the options, just for discussion only.
I certainly can do
Can
that.
you do that, just so the rest of the board gets an idea of what we're looking at, and they're not blindsided by making a choice?
I can.
Not that we have to make a decision, just throw that out there, that we're
Right.
looking at short-term or long-term and lowering that
Right.
spike.
Right.
Okay.
Okay. All right, are we finished with that? Did we cover all of that you wanted to cover?
Yeah, thank you for your help, Brian. We'll be in touch.
All right, so I'll sign off now then.
Okay, thank you.
Thank you.
All right, thanks for letting me join you today. Take care, everyone.
All right. So we've hired PMA or not?
We have not signed the contract, but
Your
yeah,
intent is to
so
do that.
they've sent us some information. They responded to an RFP from a county who's doing something very similar to us. They won that contract. We know what the pricing is going to be. So we'll proceed with that. We just want to make sure that, you know, we weren't totally off base with the direction that we're going in the planning that we're using.
So, and you don't need this committee or board approval to hire for the financial advisor.
No, we'll you know, abide by the purchasing policy. This
Right.
is the, you know, as I stated, you know, working through that process. Yes.
Okay, good. All right. Then next item is the COVID-19 account tracking. Mike, you want to
Yeah,
talk about
just-
this
sure.
before I complain?
Briefly, you know, this was done July 28th, so the numbers have changed since then. Again, sales tax is strong right now. It does show 3 accounts in here that are in a declining
Right.
situation. The interest on investments,
That's understandable.
yeah, the criminal justice, because of the whole COVID situation, that was kind of put on hold with the court, through the court systems, and I think there's probably a change in staffing there that's had some effect on that particular budget. And the ambulance numbers are down a little bit from a year ago.
Right. I
But
mean,
we did receive some COVID money there, about 50,000, so that helps offset that deficit.
so my clerk of courts were down from 248, we're down, what, $118,000 from our budget? What's going on there?
Well, clerk of courts is one of those budgets where the budget really doesn't reflect what actual collections have been for the last several years. That line item kind of got artificially inflated, and so we're slowly through the budget process trying to bring the budget down more to reflect reality.
But why wouldn't you do it at one time? You know, for 2021, why don't we say, just this is reality and budget it that way?
Because the difficulty is with levy limits, to take an $80,000 or $100,000 hit to your budget, just correcting the budget means you got to cut somewhere else. And so it's a little easier to nickel and dime it each year than
Okay,
to take the hit one year.
but you built in taking fund balance down then.
I've built intake.
Yeah, I mean, if we budget 248,000 and we only collect 130, that means we've got a budget deficit of 100 and some thousand, and where does that come from?
Correct.
Come from fund balance.
Well, fortunately, in the last several years, the general fund in total has ended up in an excess situation. So it hasn't impacted fund balance,
Very good.
but we're sliding towards the deficit for sure.
Right. So the clerk of court is then doing what they can do to collect, and 130 is
Yes.
reflects a very good effort on their part.
Yes, and maybe we could ask Marge to make a presentation to the committee next month or something.
Pardon me?
Maybe we can ask Marge to make a presentation to the committee in a month or two.
That would be a good, in my mind, a good idea.
Chairman,
Yes.
another question for probably Marge is, they get in there is back money collected. That's been pushed away because they didn't have enough staff to work on that.
Right.
And that's, yes,
But years back, it was an awful pile.
yes.
Right.
Thank you.
Okay. And ambulance fees, is that a budgeting comment, or we just aren't collecting as much as we thought we were going to collect?
Well, I think your second comment is true. I think we're budgeted conservatively on fees. So I still think by the end of the year, they'll make budget. But with the COVID, at least early on in the year, their ridership numbers were down. But I think that's rebounded now, and I think they're back up to the level they should.
Yeah, a lot of the transfers didn't happen because people weren't getting into the hospital to do this and that.
Okay. And then same kind of question on health and human services, client collections. We budget $1.6 million, and you're thinking we're only going to collect $1.2 million.
That's just because historically, that's the way that line item's worked out. So
What does that mean?
I don't know. I have to talk to Patty about that one.
All right.
Didn't we recently pass a new collection policy?
Yeah, we do.
Mr. Kinsler?
But yes, we did.
Right.
You know, it takes
And it's
time
too
for
soon,
money to
right?
come.
It's too soon.
Okay. All right. We got the sales tax treasurer's graph. Any questions on that? And the ambulance account, what's happening there, Mike?
Tom.
I think I know, but
What are you looking at?
I'm looking at 11B.
Oh, okay. LifeQuest used to do our ambulance collections. There was a period of time where they still collected on that contract, and that is now ended. And so the bank account that was used to collect that money is no longer needed. And so we're just bringing it to your attention that that account is being closed. We do authorize the opening of a new account, so we thought we would bring forward when an account gets closed. So it's just the activity has ended for that LifeQuest, previous LifeQuest contract.
Right, there's no action required by this committee.
Well, if you wanted to formalize, then it's in the record that it was opened at some point and closed at some point.
Okay, so then I will entertain a motion to close the hometown bank LifeQuest collection account.
Before we do that, I have a question.
Okay, go ahead.
Okay, for closing this account, obviously there's another account where we're receiving the money.
Well, the statute of limitations on the accounts that LifeQuest was collecting upon has now ceased, so they're not collecting anymore on those very old accounts from the old LifeQuest collection.
Okay, I misunderstood. Yeah. I'll make a motion to close that.
Okay, motion's been made and seconded to close the hometown bank account. All in favor, aye?
I,
Who seconded the motion? Thank you.
Opposed, nay? Okay. Motion carries. Any other matters for discussion in 60 minutes?
Oh, good discussion.
Right.
Good discussion.
If not, we're adjourned.